This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to take a look at the market trade as we wrapped up the week, wrapped up Friday, and of course, wrapped up the August WASDE numbers. We have Ted Seifried with us of Zaner Ag Hedge. He has joined the show here today. Ted, always great to catch up with you, buddy. How are you?
I'm doing great, Jesse. It's great to catch up with you too, man.
I appreciate the time on a busy report day joining us here to discuss and, overall looking at everything. Didn't feel like there was many surprises in the WASDE, I guess, maybe starting with those yield estimates. I know that's kind of the headline sexy number, quote unquote. Mm-hmm. Corn coming down, which was kind of expected, but soybean yield going up slightly. I think that caught some people off guard. What are your thoughts just overall with those top headline numbers we saw on Friday, Ted?
Yep. There was one analyst that was looking for soybean yield to go higher. And there it was. So, okay. But I think the trade, for the most part, realizes that these numbers were done a couple of weeks ago, and things may have gotten a bit worse since then. And I think the general consensus is going to be this is probably the highest soybean yield we're going to see on a WASDE report. It leaves us, first of all, it matches the previous record that we had in 2016. I think if you look out there and, pretty soon we'll have crop tours and things like that. I think we're going to say, okay, this doesn't look like 2016. So I don't know. At the end of the day, 245 million bushel carryover in soybeans isn't really that big. We had that knee-jerk reaction lower when the report came out, but then pretty quickly we were able to kind of shrug that off. And again, the trade calling BS on that yield number, I think. So the one thing that we did see also, along with that increase in production, as the USDA usually does, they find a way to add to demand, and they added to the export demand. For me, it's a little bit early for that. Although we started off with record new crop export sales back in January, February, it's really dried up. And we've seen a trickle of it kind of coming in from China and unknown destinations in the past, 10 days or so. This is really the time of year that we would expect them to be buying some bigger amounts. And for me, to put the icing on the cake of this USDA report, if we start to see those sales come in, then I start to feel a little bit better about the demand numbers that the USDA has. Then I start cutting the yield down to, say, a 51 national average. And all of a sudden, now we are talking about a really rather tight carryover. So I think that's really what the trade started to figure out as time went by there on Friday. We still have weather. It's still a weather market. I guess if we come back in, Sunday night and we've got a ton more rain in that forecast, that might change things. But, the knee-jerk reaction pretty quickly, well, that's what it was, a knee-jerk reaction. We pretty quickly moved past that and start looking forward again. And I think looking forward, we have a bit of a bullish scenario for soybeans in the near term, at least.
Well, and I like how you said, we kind of, call them BS. And I think the trade kind of calling the bluff of some of these numbers that came out from USDA, just because you made a great point. These were numbers as of a few weeks ago, August 1st. I mean, we've seen more deterioration, especially the Western Corn Belt. I know some areas, that have drought increasing, Northwest Iowa and Southeast South Dakota, Northeast Nebraska. That's a hot spot that I can think of off the top of my head. So, we look at things as they stand now. And as you said, now that we got the numbers here, we've digested them. The trade has gone, okay, here's what USDA says. But now it feels like it's going to go back to weather. And that's kind of, what we usually deal with in summertime is a weather market, Ted.
Yeah, and you got some 100+ degree temperatures out in the Western Corn Belt and the Plains. That's a concern. So again, what's the forecast look like on Sunday night? That's what we always want to know, and that's what we'll trade for next week. A lot of times we say this August report sets the tone for the remainder of the growing season. Well, I think the tone Okay, it's been set, but it's pretty similar to the tone that we had going into the report, right? So we'll see. As far as the corn market was concerned,
Yeah.
yeah, they kind of ripped the Band-Aid off on yield. 175.4 came in below expectations. My concern going into this report was that they would do just that, but then they would also come and really get aggressive on cutting demand and leave us with a carryover number pretty similar to what we saw last month. And if that would have happened, it takes a lot of the steam out of the bull sails, because you say, okay, well, we just saw yield drop pretty dramatically, yet the carryover is not really going down. That didn't happen. They did cut demand, but not aggressively. They cut 25 million bushel in feed and residual. By the way, FSI, they added 5 million. So, okay. And they cut 25 million in exports. I worry that longer term, that isn't enough of a cut in exports, but we'll see. We have a lot of time to prove that out. Just like soybeans, this is the time of year where we really want to see some of these bigger corn export sales, and hopefully that's coming. But either way, I mean, it's not a significant drop in demand, at least not at this point. And now you're looking at a sub 1.4 billion bushel carryover, which historically you can say, okay, that's not terribly tight. But in these days of massive demand, I mean, stocks to usage is really on the historically low end of the spectrum. So I'd say it justifies corn prices kind of where they're at, maybe a little bit higher. I'm not going to say that this balance sheet is a 750 plus new crop corn balance sheet, but it could get there. If you continue to cut off that yield, and if that demand's actually there, maybe we are talking those sorts of numbers. But at least for the time being, I feel like corn is fairly adequately priced, and it's a weather market. So if we're continuing to be concerned about weather, we'll add weather premium, and there's more upside potential. One of the interesting things that I saw on the corn side of things is in the world numbers. We raised the Ukraine 5 million metric tons.
Interesting.
Okay.
Yeah.
Okay. Who's over in Ukraine? I mean, I don't know. I don't know. I don't think anybody knows, and I don't know how they had enough justification to do that. But even with that, the lower Europe crop, which again, a lot of people would argue that number still has to come down more. 8 million metric tons isn't enough, and it's not reflective of what the Europeans are saying about their own crop. And because of our lower crop, you still have a lower, and actually even lower than expected, world carryover for corn. So that's kind of helping with the bullishness.
Ted, on the global side as well, wheat, I know Russian crop went up. We look at wheat here and look at total wheat production. I think that number was 1.783 billion bushels in the August report. Just looking at the wheat markets, though, again, it was kind of the same story. We had the initial reaction. We were lower going into the report, and we kind of firmed up a little bit. What do you make of wheat after seeing the WASDE numbers and moving through Friday's trade?
Yeah, Jesse, wheat is going to wheat. It does the wheat things. We were down 17 going into the report. The report came out, we rallied 10 cents pretty quickly, and then we gave it back. We were down 17. But then when the row crop started coming back and corn found some strength, then wheat was able to kind of come up. The wheat report, it was actually kind of a friendly report for our domestic carryover. It came in well below expectations, really. So that's great. But from a world standpoint, that Russian number going up, Russia, the numbers they've been giving us have been, quite a bit higher. And so we're sitting here thinking, okay, how is that happening? Is this because you're including the parts of the Ukraine that you've invaded and taken over? But then the USDA leaves the Ukraine wheat number unchanged. So I don't know. I really don't know what to make of any of these changes that we've seen in Ukrainian corn or Russian wheat. We know that Russia has a pretty stellar wheat crop, so maybe that's just on their original area, an 8 million metric ton increase. That's pretty sizable. It's 10%, really. So maybe. But either way, the domestic balance sheet for wheat was a little bit better than expected, and even the world numbers, despite all that, aren't really that bearish. So yeah, I'm hopeful we can find some footing. And a broader picture, Jesse, you've got a really nice rounding bottom trying to occur in the wheat right now. I think when Russia invaded Ukraine, we went higher than we fundamentally should have, mainly because that was a short squeeze. That wasn't a fundamental thing. There was a fundamental trigger, but the amount of strength that we saw was all based on a short squeeze. But then now I think we've really overextended the downside. So I think there's a happy medium in here somewhere. I think December Chicago wheat should be north of 950 to somewhere between 950 and 1050 is really where I kind of see it going, as long as row crops don't fall apart, as long as we don't have some major global economic recession or some major new conflict popping up in Taiwan, things like that. But no, I think wheat should be in store for a halfway decent recovery, and again, partially based on the better than expected domestic carryover.
Ted, I want to shift the discussion a little bit to risk management, just with the grains and oil seeds kind of overall. I feel like, there's not really a blanket approach to anything. It almost feels like it's going to come down to, looking to see what you got in your backyard, what's in your field at this point to some degree. Just because, you look at where things stand on the board. I mean, still good prices holding in here to wrap up the week. So, I mean, talk to me about risk management. I know there's so many different tools and that you can use in the toolbox, but what are some of your general thoughts as we work through into the back half of August here?
Yep. So I have a bit of a different approach to risk management this year than I did last year. Last year, the mantra was, make the cash sales to manage your risk, and then let's go in and re-own those bushels, because there is a whole lot of upside potential, this inflationary undercurrent. There's a good chance to go higher, and you don't want to miss out on it. I don't know if I feel really the same way. We're seeing inflation simmer down at least. And usually when you get inflation upwards of 10% or so, it doesn't end well. Inflationary bubble burst, right? And so I feel like this year there's a whole lot more risk to the downside than there was this time last year. So I really like the idea of, one, making cash sales, but also, a lot of guys out there aren't exactly sure what they're going to have because of weather. And I'm looking at you, Western Corn Belt. So owning puts is really not maybe a bad thing. And the idea of a price window where you're buying a put and then you're selling a call to pay for that. And the calls right now, it's not as much as it was, but you still have the premium skewed towards the calls. And you're able to sell a call that's farther away from the market than the put that you're buying. So I think it's a good strategy to be using. Now, the thing is, you got to be mindful that outright short call. You got to be prepared and have a plan to cover that up if we just are going to the moon, right? So it's something that it's a risk management strategy that needs management, so to speak. But for the guys in the East, the guys that feel like, hey, I've got a pretty decent crop here, I think you can do something similar to what we were doing last year, where you are making those cash sales, and if you want to, I'm not twisting people's arm as much as I was last year, but if you want to re-own the upside, that opportunity is there for you as well.
Ted, so you brought up inflation. I want to move the discussion there just a little bit. We saw those moderating numbers here this past week, CPI, PPI. Your general thoughts after seeing those numbers, anything stand out to you there that really we need to focus on moving forward?
I think those numbers will continue to come down, Jesse. We're not stimulating the economy anymore. That was the big driver of the inflation. It was an artificially created inflationary bubble. So because of that, I don't think it burst quite as badly because of banks not having as much exposure to cryptocurrency, for example, as they did the housing market back in 2008. I don't think this is a 2008 type event, but who knows? You never know how the dominoes fall when things start happening. That being said, I do think inflation is going to continue to abate. You look at CPI and PPI; those are kind of lagging indicators. I think we're already seeing that happening. And also, one, we're not stimulating the economy. Two, we're raising rates. And three, you look at Google, Groupon. There's a lot of these companies now starting to lay off a portion of their workforce. So Peloton was the one on Friday that was the new one. So we had been talking about jobs growth and adding jobs to the economy, but now we're starting to see that swing the other way, and that's a deflationary move. I think inflation continues to come down. So, like I said, you don't have that inflationary undercurrent that's boosting commodities as a whole, and when you take that away, even though you have some fairly friendly balance sheets, Jesse, you also have to say, you can only go for a certain amount of time up at these really historically high prices before you do start to create demand destruction. And if you take inflation away, that's the biggest thing that will help accelerate that demand destruction. So, when I look at these balance sheets and I look at the demand that we have scheduled for the entirety of the new crop here, which we haven't even begun yet, you worry that maybe some of those numbers are suspect. I don't think the USDA is justified, or even I'm not justified to really go in and slash those numbers just yet. But that's something that I'm prepared to do. And if I continue to see inflation coming down and the CPI and PPI numbers continue to come down, which again, I think they will, then I am going to have to start taking a harder look at some of those demand numbers. Initially, though, the market's reaction, both, in stocks and commodities, was friendly to lower CPI and PPI numbers because the idea is that, okay, maybe people will feel more comfortable going out and spending again. But realistically, no, inflationary numbers coming down isn't necessarily a bullish thing for commodities.
Ted, how about your old buddy, the crude oil market? You and I, since the last time we talked, we've seen a decent amount come off of this crude oil market. So what are your thoughts there and with energies as a whole?
Yeah, I've been pretty vocally short the crude oil market for some time. But we are also finding the 200-day moving average, and we have tried to get through it 4 or 5 times and not been really successful doing so. So we kind of figured we'd see a little bit of a bounce. I got out of a lot of short positions earlier in the week. We had a little bit of bounce, but then today, Friday, is not a really good follow-up to that. So a bit more of a risk-off day again on Friday. Crude to me, fundamentally, you can really, the bullish story is really still there for crude. But then you look at the price action, you look at the charts, you talk about inflation coming down, you talk about people getting laid off, you talk about raising interest rates, and you worry that demand destruction accelerates fall into winter. And you look at crack spreads, the margins, the profit margins these refiners are getting, they've been coming down pretty dramatically too. So that's kind of telling you that, even though we're pretty much exhausting our strategic oil reserves, and there's really not much more to fall back on, and that at some point we should start building it up again, and so on and so forth. Price action and profit margins kind of tell you that there might still be more downside potential. Again, fall into winter. But longer term, I don't see a collapse coming in the crude oil market. I think, one point I was talking about $54 is my target. Now I'm starting to feel that might be a little bit too low. And that was for December crude oil, by the way, which it wasn't at the higher levels like September was anyways. But yeah, no, I do think that we are sort of I think this whole economic slowdown, for the last couple of weeks, we've been sort of feeling warm and fuzzy, like, oh, recession's over. And I think that comes back fall into winter, and I think a lot of these things have some downside potential. But like I said, I don't feel like this is a 2008 type scenario. At least that's not how I'm feeling at the moment. Again, you never know how the dominoes fall, but I don't really see that at the moment. But I do think you're going to have some cooling overall in a lot of these commodities. We've seen the start to that, and then we've kind of felt better about it for the last few weeks. But I think this macroeconomic selling is going to come in. It's going to be in play at some point again between now and the end of the calendar year, probably September, October timeframe.
Mm-hmm. Very true. Ted, we got a couple minutes. I don't want to forget about our livestock guys and gals. Felt like kind of a choppy lower day in livestock on Friday, but overall we saw a good cash trade in cattle country. And then on the hog side, that August contract going off the board on Friday at a premium to that October contract. So any thoughts of the protein sector as a whole as we wrap up the week, Ted?
Yeah, for hogs, we're down just a little bit, just kind of pulling back off that new recent high. Yeah, I think it's just a little bit of a correction in nature. As far as cattle are concerned, higher cash, that's good, and that's generally, obviously that's a pull effect on the market. The thing I'm worried about a little bit though is box beef prices have kind of simmered a little bit. So you wonder if we're going to continue to see those higher cash prices as we put a little bit of stress on packers' margins. So I am kind of talking with producers about doing some sort of limited risk management, buying puts, for example, having some downside potential, but not terribly aggressive. Because again, talking about economy, talking about things like that, you worry that maybe domestic demand does simmer as we get out of the grilling season and the summer of love, everybody trying to get back to feeling normal again and whatever. We've had our fun, right? So into the fall, things I do worry could slow down a little bit. So that is a concern of mine. But in the near term, aside from corn prices reversing and going higher and putting pressure on the feeder cattle, I'd like to say I think there is some more upside potential in cattle. Again, I still think we have a period of time where domestic demand will stay relatively strong. But I do worry about, again, what happens fall into winter.
Well, Ted, fantastic as always. We're up against the clock, but I know if folks want to reach out to you and get some advice there with Zaner Ag Hedge, they could do that very easily. How can they reach you, Ted?
Yeah, you can reach me directly at 312-277-0113. Aside from that, you can find us on the web at www.zaner.com. You can read a bit about us. You can also sign up for our morning Ag Hedge newsletter. And also you can find me on Twitter at the Ted Spread.
Ted, always a pleasure, buddy. Thank you for the great thoughts and analysis today. Enjoy your weekend, and we'll talk to you again real soon.
Thanks, Jesse. You have a great weekend too. Talk to you soon, buddy.
Ted Seifried with Zaner Ag Hedge joining us today here on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great weekend.